Welcome back. In this video, I will discuss the bear put spread and the bear call spread. These are again two option strategies, that is, they involve trading two options simultaneously. Both these spreads are employed when you have a bearish outlook on the price, which is why the name of these spreads is the bear put spread and the bear call spread. Now let's look at these strategies one by one, and I will also discuss which spread should be used when. First, let's start with the bear put spread. This spread involves buying a put option and selling a put option of lower strike. For example, on the right, you see that we bought the Reliance put option of 2100 strike and sold the Reliance put option of 2000 strike. Both these options have the same time to expiry because they both expire on 25th of March. One leg of this strategy involves a long put position, while the other leg of this strategy has a short put position. By taking these two trades simultaneously, we create what we call a bear put spread. You can buy this spread when you have a bearish outlook on the price of the underlying security. The natural question you would ask is, how do you select the strike price for the put options of this strategy? Now this depends on your view on the market. Let's say you have this view on Reliance, that is, you want to go short around the current price of 2137 for a target price of 2000, and your stop loss price is 2200. In this case, you can buy the put for a strike closest to the current market price, provided there is enough liquidity for that strike price. So for example, the 2100 strike put option is pretty liquid and it is the nearest strike to the current market price, so we can go long the 2100 strike put option. This will be the first leg of our bear put spread. For the second leg, we can sell a put option with a strike close to the target price of around 2000, assuming that there is enough liquidity for that strike price. In case of Reliance, since the 2000 put option is liquid, we can sell the put option of this strike. So by buying the 2100 put and selling the 2000 put, we have created a bear put spread. Since the strike price of 2100 put is closer to the current market price than the strike price of 2000 put, the 2100 put is going to be more expensive than the 2000 rupees put. You will need to pay to buy the 2100 put, and you will receive a premium for selling the 2000 strike put. Here you see that the 2100 strike put is available for 34, while the 2000 strike put is available for 11 rupees. Since you buy the 2100 put and sell the 2000 strike put, there will be a net outflow from your account to initiate this strategy. In this case, you will be paying the net premium of around 5738, which is the difference between the price of the two puts multiplied by the lot size of 250. Now let's look at the payoff diagram here. The dashed line here represents the payoff for the trade if you hold the trade to expiry. In this scenario, your maximum profit will be around 19,000 and the maximum loss possible is the net premium paid by you, which is around 5700 rupees. However, if your stop loss or take profit is hit on the same day as the day on which you took the trade, then your payoff will be represented by this solid line here. What this means is that if the trade immediately hits the target price, then the profit you earn on closing the position today itself would be lesser than what it would have been if the target price was hit on the day these options expire. Similarly, if the trade immediately hits the stop loss price, then your loss on closing the trade today itself would be lesser than what it would have been if the stop loss was hit on the day these options expire. So as the days pass without either your stop loss or target price getting hit, your potential profit on the trade increases, while the potential loss on your trade also increases. If your stop loss or target price gets hit on expiry day, you will see your maximum loss or maximum profit as shown by the dashed line here. Next, let's look at another type of spread that can be used if you are bearish. It is known as the bear call spread. A bear call spread consists of selling a call option and buying a call option of higher strike. Both these options should have the same time to expiry. On the right here, we have constructed a bear call spread by selling the 2200 strike call and buying the 2300 strike call. Both these options have the same time to expiry because they both expire on March 25th. When you sell a call option and buy a call option of higher strike, you execute a bear call strategy. Now let's look at how do we select the strike price for a bear call strategy. Let's say here your outlook for Reliance is that you expect it to move to the target price of 2000 and you decide that your stop loss will be around 2200. Now in order to create a bull call spread, you will sell the call option with the strike closest to your stop loss price. So you can sell the 2200 strike call. You need to make sure that the liquidity is available for this strike price. For the buy leg of the bull call spread, you can buy the call option of a strike that limits your loss to a reasonable level. In this case, we have bought the 2300 strike call option. Now let's see the payoff diagram to understand the risk and return when we take the trade with this strike selection. Here we see that the 2200 strike call is worth 34.4, while the 2300 strike call is worth 13.8. When you sell the 2200 strike call, you will receive a premium of 34.4, and when you buy the 2300 strike call, you will pay 13.8 rupees. This means you will net around 20.6 rupees. When you multiply this to the lot size of around 250, it comes to the amount shown here. So when you initiate this trade, you will receive a net premium of around 5150 for each lot traded. Now the dashed line here shows the payoff if you hold this trade till expiry. In case of this trade, if the prices stay below your stop loss of 2200 on the expiry day, then you will actually make profit of around 5100. To lose on this trade on the expiry day, the prices will need to go above the 2221 level, which is basically the strike price for which you sold the call plus the net premium received of around 21 rupees. Since our stop loss is 2200 and since we sold the 2200 strike call, we will end up with some profit if the stop loss price is hit on the expiry day. However, if your stop loss gets hit today itself, then your payoff will be decided by the solid line shown here. So if your stop loss gets hit on the same day on which you initiate a trade, then you will lose around 3000 rupees on this trade. Similarly, if your take profit price of 2000 gets hit today, then you will make around 4000 rupees. If however neither your stop loss or take profit price is hit, then as the day passes, the solid line will slowly converge to the dashed line here. What happens is, as days pass, you start accumulating theta because of the short call position, while you lose some theta because of the long call position. Since your short call position is of higher value, you accumulate more theta due to this leg, and comparatively you lose much less theta because of your long call position, as this long call position is of lower value. So on balance, you end up accumulating theta each day the prices stay below your stop loss price. This results in this solid line curve slowly converging to the dashed line curve over time as the expiry nears. Now let's look at when you should use each of these strategies. Both bear call spread and bear put spread are useful when you are bearish on the market. However, there are times when you should prefer one spread over the other. The primary consideration for you when selecting these strategies should be time to expiry. It is best to deploy the bear put spread when you have at least 3 to 4 weeks remaining to expiry. This is because when you execute a bear put spread, you are a net payer of premium. This premium is basically the time value of the options involved, which means for every day you hold the position, you will be losing some theta. And this theta decay would be quicker if time to expiry is less. Conversely, the theta decay will be slow if there is at least 3 to 4 weeks remaining to expiry. For this reason, you should prefer initiating a bear put spread when you have at least 3 to 4 weeks remaining to expiry. Conversely, when you are 2 to 3 weeks or less away from expiry, then your theta decay will accelerate. Now when you initiate a bear call spread, you will be receiving some premium. In this scenario, the theta decay would work in your favor as short call option will start losing value progressively faster. In this scenario, it becomes better to execute a bear call spread as such a position gains value rapidly every day due to theta decay. So for example, if you are going to initiate your trade on the 1st of March, you should execute a bear put spread because you still have more than 3 weeks to expiry. Conversely, if you're going to take a position on 9th of March, you should execute a bear call spread because you have less than 3 weeks remaining to expiry. Another secondary factor you might consider is volatility. Generally, when volatility is low, the option premiums are lower, which means executing a bear put spread will be cheaper as the premium of put options involved would be lesser. So the best time to buy a bear put spread is when the volatility is low. Conversely, when the volatility is high, you can execute a bear call spread as option premium will be higher and you would receive higher premium if you execute a bear call spread. So for example, if IV percentile for the stock is less than 40%, it means that the volatility is low compared to the historical volatility, and in this scenario it's better to go with the bear put spread. Similarly, if the IV percentile is greater than 60%, it means that the volatility is relatively high, so it's better to go with the bear call spread. I would suggest keeping volatility as a secondary factor and primarily choosing the strategy based on time to expiry because the theta decay is going to be a more potent factor for short-term trading.